Okay, welcome everybody. Just give me a few seconds here to check the sound. I've got a new audio mixer today, so let me know in the comment section if something is wrong with the sound. Typically, I've got it to where it's pretty decent, but this is a new machine, so let me know. I'll actually show you something. I'm pretty excited about this. As many of you know, I travel a lot. I try to travel light. So this one on the top that you're looking at, this is the old audio mixer that I was using. This thing is huge. It's way bigger than my computer. This little black box on the bottom left is what I'm using now. So pretty excited about it. It'll definitely allow me to travel a little bit lighter, but let me know what it sounds like. So looks good. Looks like the audio levels are fine. For anybody interested, I am kind of a super amateur videographer, but I am kind of interested in this stuff. So this is a Shure SM7B microphone, and it actually requires a lot of power to make it sound decent. Otherwise, if you just plug this into a computer, nothing comes out. It would be dead silent. So it actually needs 48 decibels of clean gain added to it. And so it might not sound like a big deal, but to have something that small that can still power this microphone, pretty excited about it. So one other piece of housekeeping that I want to get this out of the way. I typically do live streams once a week for everybody, different topic, open Q&A. Everybody loves the Q&A. But I've been sick recently, and no, it's not, it's not the Rona. The pandemic makes it so we're going to have to, no, it's not that. It's just regular flu. But I have been sick and I've been delaying it. So during today's live stream, if I do happen to need to pause it and just, duck out for 30 seconds and clear my throat, bear with me. That it might happen. I'm not sure. But anyway, thank you so much for showing up. This is episode 21 of the Volatility Barometer. So we are talking about the impending doom of the retirement crisis. And I just want to draw attention to a few things that people may or may not consider when they're actually planning for their very long-term retirement. So the basic rundown, we're going to talk about what the S&P 500 performance has been in the past. Of course, that's always a good place to start. We need some recognition of actual historical values before we can start planning portfolios and whatnot. And that number, spoiler alert, might be a little lower than people think it is. But number two, we'll talk about why I personally believe, and this is kind of the heart of what we're talking about, why I believe it could be substantially worse going forward, to the point where, not to be too hyperbolic, but I feel like it could actually, over the next 20 or 30 years, it might approach something close to 0%. So bold statement, I will back up why I actually think that. And then third, we'll get to that third point where I'll actually give a few tips here and there about how people can potentially structure things differently so you may be better prepared. And if you're anywhere close to my age, I'm 46 years old, the next 25 years is right in that range where a lot of people are thinking, I've got to get going from here forward. As we know, the statistics are pretty grim out there. There's, over half of Americans, for example, we've seen studies that show they can't even meet a $500 emergency expense. So this is definitely something that people want to pay attention to. And remember, the situation that people are in now, that's based on a pretty dream setup for investors over the last, say, 25 or 30 years. I'll get into that as well. But if the future's not so bright, or as grim as I think it might be, approaching 0%, people really need to start thinking about that today, because it could be a real problem. I don't mean to be hyperbolic and scare anyone with the crisis, but it legitimately is a retirement crisis on our horizon. So, and then of course the open Q&A, you can ask me anything you like, volatility trading, options trading, VXX trades, whatever you want. We'll get into that later. So 1 minute of housekeeping, and then we'll get started. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, so let me try to get through this relatively quickly. You all know my style. I can go off on tangents, but throat's feeling pretty sketchy right now, a little bit scratchy. So hopefully I can do this. I don't know. Can I speak 20 minutes uninterrupted? I'm really not sure. But the point of this live stream, like I said, is I don't think people pay enough attention to the fact that with investing, obviously by far the most important aspect is starting today going forward. I think a lot of people get trapped in the pattern of looking at historical data and actually weighing it too heavily. And what they should be doing, of course, an understanding of history is fantastic. You should definitely mine past data to draw your own conclusions, design a proper portfolio. But at some point, you really have to understand that we're all, flying in the dark here, and we have to predict starting today going forward what the world will look like. And I think that's where a lot of people fail. I do get a lot of emails every day. I answer 4 to 5 hours of emails every day from, community members. And you'd be surprised how many people, when they're planning for their retirement, when they're talking about stocks and all this performance and what it's going to mean, where it fits into their portfolio, a lot of people just have this wildly unrealistic expectation of what the stock market can do for them. And while, of course, my portfolio, my business, my life, basically, in investing sense, is largely based on the stock market, options trading, volatility trading, the fact is the stock market could be extremely disappointing going forward, and we do have to pay attention to that. A lot of people, I would say the vast majority of investors, have no context before, say, 2009. That's just the way that it works. More new investors coming in, the number of actual veterans who have seen different environments is smaller and smaller. And we've been in a period where for the last 12 years, minus a few months here and there of crashes, the stock market has been cooperating with everybody's expectations. So they have this idea that this is just going to continue, and that's how they're going to fund their retirement fund. So obviously we need to get into some actual numbers on why this may not hold true going forward. The first thing I want to point out is, depending on what type of investor you are, you may have actually seen financial advisors, even today, the vast majority of advisors are still talking in terms of these sort of diversified portfolio buy and hold style pie charts where, I'm sure you've seen them. They put a certain percentages of things in different things. You've got domestic, international stocks, money market, bonds, and you basically just hold the portfolio. And then they'll tell you, a lot of advisors, even today, will be telling their clients that these portfolios have made, the standard number they give is typically 7 to 8% a year. They'll say that this portfolio has returned 7% a year for the last 20 years. So this is a good structure and this is where your money should be. And your money's safe. And of course, you can pay the advisor and he's happy and you're happy with your 7% a year and everybody's great. Well, is this realistic going forward? Is this actually going to return 7% to investors? So the first thing we have to understand is that the S&P 500 has not actually returned anywhere close to what people think it has returned. What we can look at, there's a good website here. Where's my favorite website here? This one's called DQYDJ. It basically stands for Don't Quit Your Day Job. And there's a lot of tools and little calculators here and there. I like to go to this website to get basic, S&P calculators, retirement calculators, makes things easier. So what we can try to get an idea of today is, first of all, like I said, what has the stock market returned in the past? So if we go to a basic 20-year, I don't know if this is going to surprise anybody. Of course, we have to adjust for inflation. So, little side tangent here. This button and everything we do in the investing world obviously is going to be extremely important going forward. It always was. Absolute numbers are never a good idea. You shouldn't measure returns based on nominal numbers. Inflation adjusts everything. But, this is the Federal Reserve balance sheet, $8.3 trillion. Obviously, this is not a good situation, and this is happening recently. So, inflation may actually be a result of things that the government, the Federal Reserve, and all the powers to be are doing to us right now in our economy. This is the federal debt, $28 trillion U.S. federal public debt. That is a staggering number. For comparison, the actual GDP right now in the U.S. is less than 23 trillion. It's 22.8 trillion. So that leads to a ratio of public debt to GDP of 127%. Just a staggering number. We are basically printing, for lack of a better word, it's not technically money printing, but for lack of a better word, money printing our way and borrowing from taxpayers our way to quickly, I don't want to say destroying the economy, but certainly putting a lot of stress on this economy. And to get this under control, it was never good, right? We have always, for the last 70, 80 years, we have always funded growth with debt. There's nothing necessarily wrong with that as long as the income is more than the debt that you're borrowing, right? There's nothing wrong with taking on leverage as long as you use that to make more money than you borrowed. And that was the case for a very long time. But of course, since 2009, that equation has quickly changed to where now we are borrowing a staggering amount of money and our GDP itself is not keeping pace. So now we're in a lot of trouble where our borrowing is far higher than our actual production. This is not good. So point being, obviously inflation adjusts everything that you do and all of your thinking from this point forward, if you haven't already. This was always important, but certainly for now. So in the last 20 years, just a straight up 20-year period, the S&P 500 has returned 4.37%. Now, if you reinvest the dividends, essentially means buy and hold, set up a DRIP, a dividend reinvestment plan, and you just let the money sit there, you can bump that up to about 6.4. Now, I would highly encourage people to consider not doing this. I don't tell anybody what to do, what not to do directly, but buy and hold investing will lead to excruciating drawdowns. And more than likely, if you go on that path, you will probably at some point capitulate in a panic when the markets look like, hey, they're crashing and they might not come back. Maybe I shouldn't buy and hold. Bad decisions get made when you're in a 50% net worth drawdown. So I would advise people to just look at this top number. This is what the S&P 500 has returned in the last 20 years. Now, to get an idea of what this period is, I think it's a fair assessment. I think that that's a fair number. All these people that are saying the S&P returns 10 or 12 or 13, they just have no concept for history. That's not what the S&P has returned. We are just happen to be in a market where the elites, the bankers, everybody is just keeping the train on the track at every step of the way, and it's been a pretty staggering 12-year run here. But with a little context of history, we can see that it's substantially less than that, 4.37. So where are these dates? This is why I think that this is in general, a fair assessment. I just want to make sure I'm on a screen share. I don't want to cut everybody short of not seeing what I'm pointing at here. So where are these dates? Obviously, we're at all-time highs. So it's starting from a, today going forward area, pretty bad spot, but all-time highs. July 2001 is right in the center of this downdraft. So that's why I say it's kind of fair. If you wanted to get somebody who cherry picks the numbers and makes it look like the S&P is really, really much better than it is, they might choose a number down here. If you get people who want to show you that the S&P maybe isn't all it's cracked up to be, then you might want to start here. I think July 2001 is a pretty fair date. But cherry picking is a legitimate thing in the market, and you have to understand what a person's intentions are when they're talking to you. Are they trying to show the S&P being really good, or are they trying to show it really bad? You can adjust the dates just a little bit, and it makes a pretty large difference. So as an example, I can use a different 20-year period for this. I could use March 2000 to March 2020, right? That's also the same 20-year period, different period, but same time frame. Well, now we're less than 1%. If you just cherry pick it a little bit, you can paint a picture that shows the S&P 500 is an absolutely abysmal investment. On the flip side, you could paint a picture that it's much better than it is. You could start at a low and end at a high, and that number will sound much better than it is. So for today's purposes, I don't want to be accused of cherry picking. So I'm going to choose the absolute best possible situation for an analysis of the S&P 500. I'm going to go back to 1990, the very beginning of that uptrend for a 10-year really strong bull market run. I'm going to start from 1990 and end at all-time highs. Clearly, I couldn't cherry pick better numbers than that. And that's what our baseline is going to be. So we're going to go back to July. I'm going to go from 1990 to July 2021. Completely cherry picked. This is the best the S&P 500 will ever look on a chart. 5.8%. So this is our baseline number. The S&P 500 does not return 10 or 12, and all those people that say, hey, just put your money in index funds. I don't know where they're getting their numbers, but clearly there is also drawdowns as well, and you have to include those. You can't just include a 10-year bull market and say this is what it returns. Obviously, markets go down as well, so we have to include those. This 31-year period, I don't think that that's realistic going forward, but again, I'm cherry picking the best possible. And now we're going to start chipping away at that 5.8% number. And I'm going to try to give you an idea of why I'm saying there might actually be a retirement crisis that people don't really see coming. So this is a slideshow. I'm not going to play it as a slideshow. I want to use my pointer. I want to speak with my hands here. But the first reason why I think that 5.8 could be substantially lower starting today going forward, reason number one is just pure math. We are currently at all-time highs. So whenever you're looking at performance for stocks, like I pointed out, starting and finishing points matter an awful lot. The fact that we are starting at an extreme high after a basically, we can say more or less uninterrupted 12-year bull market. I mean, sure, you could count COVID as technically a recession, but it was recovered in 4 months due to insane measures by the Fed and the government, and it was basically gone before it even materialized. So you can call it a recession if you want. This is a 12-year run and we're at all-time highs. Just purely mathematically speaking, where's my thing? We are at all-time highs, and starting today for the next 25 years, just because of that, we can expect it to drop down. So I don't know, maybe 1%, whatever it's going to drop down, just pure math. Number two, like I mentioned, we haven't seen a prolonged recession in 12 years, which is pretty surprising. The average recession cycle in the United States is about 6 years. And again, while we technically might count this one on, historically, it's probably going to rank because GDP dropped to insanely low levels. Obviously, that's going to count. But realistically, from the stock market's perspective, I don't think we're counting that one. We are at some point going to see one of these, or personally, I believe maybe something even worse. Like I said, we are at just alarming levels of debt and staggeringly low levels of GDP in relation to that debt. So I don't think we're just going to skate out of this with the rest of our lives looking like this. We are very likely going to see some pretty significant corrections. And next time, it might last a while. I mean, you can see some of these last for several years. The S&P 500, basically from 2000 all the way to this point here in 2013, you could say it was flat. It was in a drawdown for 13 straight years. There's been periods in the past, right, from 1929 to 1956, basically a 25-year drawdown. It does happen. And what I'm trying to paint the picture of is, if you're trying to plan for the next 25 years, don't discount the fact that we are going to see some trouble. This insane Federal Reserve measures is really not going to be sustainable. So reason number three, we are far less efficient with our production. And by this, I basically mean our human production, our human capital. There is a very, very big difference between the employment situation in 2021 versus 1990. I don't think anybody, even if you're the most bullish on our current economy, I don't think you can make a realistic case that it's the same thing. We've just got more people who are requiring social safety nets. We are now currently overtly paying people to not work. We're still borrowing money at staggering levels, but we're not replacing that with incentive to work and produce and actually grow the GDP as well. So we're in a pretty grim situation here where both of these things are going the wrong direction. And that in itself, you could knock 1% or 2% of expectation going forward off of stock market results. Number 4, the big one, inflation is on the rise. Now, with inflation, while it is technically true that asset prices will also go up if inflation goes up, right? Real estate prices will go up, stock market prices will go up because everything is priced in dollars. And if dollars basically suck going forward, then that will make it appear on a nominal level like asset prices are also going up. But on a real level, when you deduct that inflation, it's going to be much worse. Historically speaking, there is a fairly consistent pattern, a fairly consistent relationship between inflation, interest rates, wage growth, and asset prices. They don't track exactly 1-to-1 all the time, but on a long-term chart, they should more or less keep pace. However, based on the extreme measures in the economy, based on the fact that we are working way less and producing way less and spending way more, I think it's fair to say that the inflation number might start eating a little bit of that as well. I'm not going to wipe it all out, but again, let's just say another 1%. I would imagine it's going to be way worse than that. Feel free to trust the government CPI numbers if you like. I personally don't. I think inflation is much higher than the official numbers are representing, and it's probably going to get worse. But inflation's the 4th one. The last one, and this is also an important aspect, diversification into other assets. Now, if you look at something like the Vanguard VBinks, for example, the Vanguard VBinks is a 60-40 balanced index fund that includes bonds. Let me go back and do a little side rant here. The thing about bonds as well, and you have to remember there is an inverse correlation, an inverse relationship between interest rates and bond performance. So as interest rates go down, bond funds go up. Everybody's happy if you're investing in bonds, if that's the case. If you start with interest rates at 20% in 1980 and you go basically down to 0 now where we are now, this has been a 35 plus year bull market run in bonds. So you've got a situation where the baby boomers who are retiring now, they have benefited from both a stock market that is seen incredible growth because of financial engineering and really no super long extended bad periods, and a 35-year bond bull market where the average 60-40 balanced index fund, that's why these asset managers are still telling their clients, this is what you're supposed to be holding. They're not factoring in the fact that the bond bull market is mathematically over. That doesn't mean that it's going to end in negative results, but it couldn't possibly keep pace with what it was doing for the last 35 years. It's mathematically impossible. How could you go from rates from 20 to 0 and then just keep going for the next 35 years? Keep going to where? I mean, the bond bull market is over. Doesn't necessarily mean you shouldn't ever hold bonds. Doesn't mean that you can't hold them to maturity and still get your coupon rate. But it just means that the bull market is the realization that mathematically both stocks and bonds are in trouble can be visualized. Again, screen share. This is the Vanguard VBinks. Let's go to a long-term chart of this. Once you start diversifying away from the stock market, which obviously everybody should do, you can't put 100% of your money in stocks. Well, compared to what we just said, the SPY is at 5.8% return annualized, which isn't very high, and we've whittled it down basically 1% on 5 different points down to almost 0. Well, if you start including bonds, it's half the performance already. So that's why I said, once you start including diversification into other assets, the initial starting point of 5.5% return for the stock market over the last 31 years is not even close to realistic about what it's going to be for the next 31 years. Depending on your age, depending on the time frame, pick your time frame, the next 10, 20, 30, whatever it is. Point number 1, mathematically, it's going to be lower than 5.8 because we are starting at an incredible high. I mean, just a peak. That doesn't mean we're at the peak. It could keep going up. I'm just saying that when you start at such a good point, you should expect 1%. So now we're at 4.8. Prolonged recession will eat away at that. Let's say 1%. It'll probably be more, but let's say 1. Now we're 3.8. Then you get to less efficient production, GDP going the wrong way compared to spending. Now we're at 2.8. Go to the inflation. Are we going to only say 1%? That's fine. Let's say only 1. Now it's at 1.8%. Then you diversify into what? Bonds, precious metals, real estate. Real estate's also at a high. Bonds are at their high. Stocks are at their high. And I suppose people are going to start in the comment section jumping in and saying this is where Bitcoin saves the world. But I don't know. I mean, we can have a live stream in the future about Bitcoin, but I don't know if that's the case. Is anybody going to put a significant amount of capital into that? Well, what are you going to do with the rest of your money? So diversification is also going to mean that that 5.8% number, which is already probably lower than most people thought it was. Did you know that the S&P inflation adjusted has only returned 5.8% in the last 31 years? A pretty solid 31 years. And we spent $28 trillion to get to that 5.8% in this economy. The Fed put a balance sheet of, epic proportions to get us to that point. And we got 5.8% out of it. Bonds are done. Stocks are in trouble. Inflation is going to be something we battle with. I'm not going to outright say it's going to be out of control because maybe it won't, but it's going to be something we battle. And real estate's, you can invest in real estate, obviously. It's also at an all-time high. People are facing problems. And this is why I say, for somebody who is sort of in the ballpark of where I'm at, 46 years old, I am sort of looking at that. What am I going to do for the next 20 to 25 years? How am I going to beat this? And what I wanted to do is set the table here for a few tips, but each one of these points, I would actually like to do future live streams about each one of them because we can unpack each one of these points and give people a real plan of attack, not just say, hey, you should consider this and that, but a real plan of attack. And you'll know what I mean in a second. Point number one, earn more money. You need to earn more money. Now, again, we need to unpack this because that's far easier said than done. I just earn more. Oh, really? I didn't know that. Obviously, that's one of those things where everybody knows. But what I'm essentially meaning is wherever you're at in your life, I don't know where you are mentally. I don't know where you are with how you budget your time, what you focus on. But there is, in this day and age, I feel, and maybe I'm wrong, but I feel less incentive, less overt coaching of people focusing on their careers. There does seem to be this attitude out there that work is just supposed to be something that you kind of do on the side. And, you'll get around to it when you can, and you'll make whatever money you can make. And maybe the government will be there to pay us if we fall short. If there's a little bit of a gap there, maybe the government will give us some money. What I want to encourage everybody to do is try to flip your mindset to the point where work is our life. I mean, I know certainly as a man in this world, I do feel like work defines us. And I want to encourage people to get more to that. It doesn't mean you can't have fun. It doesn't mean you can't do your other things. Of course, life is about balance. But you really do need to focus on income now more than ever. Because if I'm right, in the next 25 years, the average return of all these assets that we're talking about is half or a quarter of what it was. We are actually going to need higher incomes in order to get to our goals. So, we'll unpack it later on, but for guys out there, maybe girls as well, I don't know, but put down the video games. My video game is growing my assets, growing my account, trading, getting into Thinkorswim, doing spreadsheets, crunching numbers, building strategies. That's my video game. I don't play Call of Duty. I play trading. I play Thinkorswim. I play data analysis. That's my video game. Other things like get healthy, work out more. That does matter as far as building careers. Consider starting a side hustle. You never know where it's going to go. It might make an extra 500. It might make an extra 10,000. You really don't know where it's going to go. But certain things like that, I would encourage people to really revisit the thought of trying to build a life that is based more around finding fulfillment at making money rather than making money and then just kind of doing the best you can. Because we are not facing the same world that our parents were. It's just not the same. I know asset managers out there who don't really want to do much work. They just want to charge their 1% assets and put you in a pie chart. I know they're going to convince you that it's the same world. Look at the stock market. It's doing great. All you got to do is a pie chart. I'm telling you, that is not the world we live in today. And for all of us who are starting today looking forward, it's going to be about work. It has to be. You have to have a larger focus on work. Number two, Save more money. Stop spending money on dumb shit. We just have to stop doing that. Luxury items, trying to impress people we don't even know, falling victim to social media, all these things that we do that you may not realize how much it is. But when you add it all up, you've got the brand new iPhone because it's the cool thing and you don't want to be seen with a phone that doesn't have the triple camera or something like that. You need the new one every single year. You need the new computers, the new cameras every year. You need that cool car. And it has to be brand new because you don't want your neighbors to see the 4-year-old BMW. You want the brand new one in your driveway. All this stuff that we do to impress people, you may justify it, but it really does add up. You have to start thinking as a minimalist. I don't mean you have to have nothing. Like, I have virtually nothing. I am a minimalist. And, I'm not, saying anything that I'm not trying to be rude, but I actually do make a very large income. So I'm a 1%er, but I'm still a minimalist. I can fit all of my belongings in 2 suitcases. I travel a lot. I really don't own anything. I don't buy anything. My phone. I showed this last time. This is an iPhone 7. Now, can I afford a new iPhone? What are they at? 13? Yeah, of course I can. I buy Vanessa the brand new phones when they come out. We just got her one, maybe get her another one. I just use old phones that I find in a drawer. I'm not bothered by the fact that this is a 4-year-old phone. I just don't buy stuff. I just don't have stuff. I wear shirts that, there's one t-shirt that I like that's $12. I just buy one of every color. I'm not trying to impress anybody. And I want to really encourage people to perhaps consider focusing on minimalism a little bit, trying to reduce your life. I guarantee you'll be happier and you will make more money and your future will be much, much brighter. The other part here, of course, I'm not a tax lawyer. I'm not making any recommendations. But if you do have the type of business that you are fairly location independent, as more and more people in this social media age are these days, I am personally, that's why I travel a lot, you might want to consider trying to reduce your tax burden. There are ways to do that. Now, if you're American, it is a little bit trickier. The US is one of the only countries that taxes your money no matter where you are. But, you might want to consider starting that side hustle, incorporating yourself, trying to start writing off a home office, try to write off some of your 20% of your vehicle kilometers that you're driving. Start writing off some of your mortgage payments, some of your utility bills, your computer that you want, the new phone that you want. If you have a business incorporated and you do everything legally, there are actually ways where you can save a few hundred or maybe a few $1,000s a month. So this is another tip that I would have. Of course, we can unpack that in a future live stream. Number 3, you need to invest wisely. I'm not saying you have to believe everything I went through today. You don't have to believe me that I personally think a 60-40 balanced fund, it really could make 0% over the next 30 years. When I'm 71 years old, 25 years from now, I'll come back and I'll do an inflation-adjusted measurement of how much the Vanguard V-Banks made over that 25-year period. It wouldn't surprise me if it's 0. But you don't have to believe me. You can believe whatever you want. I'm just saying that you have to start thinking out of the box with your investing. You have to start finding ways to outperform the stock market. The only way you can outperform the stock market, unfortunately, you can't just add leverage to it, because what we know about drawdowns, they are more punishing than periods of gains. So if you just add leverage to this and you're highly correlated to this, you're going to make a lot of extra money here. You're going to lose a lot of extra money here, and the losses are more harmful to long-term growth than the gains were beneficial. And so you'll end up at a spot that's even worse. The point being, you have to decouple from the stock market in order to beat the stock market. You can't just do a 98% correlated stock strategy and expect it to do well somehow. It's not going to happen. It would have done well here, and you would be deceiving yourself to think that's going to continue, because you're going to get one of these. And if you're highly correlated to the stock market, I have bad news for you. Your performance is going to suffer going forward. I actually did a recent article on my website. I feel like it's quite recent. If you go to my website, you can see them all. But Article 620 right here, I was talking about this exact thing, is that you need to decouple from the stock market in order to actually get some decent performance. I was highlighting the fact that among our performance statistics for VTS, the real important one is the correlation to the S&P, only 34%. We're basically uninterested in what the stock market is doing. It doesn't really matter for my performance. Vanguard VBanks is 98% correlated to the stock market. The HFRI hedge fund index is 95% correlated. Asset managers, RIAs, fund managers, pie charts, buy and hold, where you're including precious metals and real estate and emerging markets and all these things, they're 95% correlated to the stock market. They will crash with stocks. What you need to do is reduce your correlation with out-of-the-box investing or alternative investments. I'm not a fan of Bitcoin, obviously. I've had plenty bad to say about it, but it is an alternative investment and it is something to consider for a small percentage of someone's assets. Real estate investing with, buying properties and renting them out. It's not my thing. I think it's good. I know how to do it. I think it could be successful. Not my thing, but it might have a lower correlation to the stock market. But point being, decouple from the stock market. It is really the only way to outperform it going forward, because stocks are going to be worse. Bonds are going to be worse. Real estate's going to be worse. All of these things, we are facing massive headwinds. How are you going to beat it? Well, you only have one choice. Decouple from it. Do something else. Invest your money somewhere else that isn't dependent on that for your results. Because there's going to be some periods in the future where the stocks are going to be pretty grim and you don't want anything to do with it. Last thing, this is probably very important going forward as well, but try to have a mind, at least an eye towards capitalizing on crisis. This is something that a lot of people overlook. You don't always have to crush it in every market environment. But if you can capitalize on a few of these periods where every now and then you're going to get some extended period of drawdown, doesn't necessarily have to mean you shorted the market and you made money. It just means that if your stock portfolio actually flatlines during that period, say, does this, well, now you're going to be starting at a much better point because you avoided most of the ugliness. And now you can start going up again with the stock market, like most of us do. In bull markets, most people make money. And then you get to this point, and instead of crashing catastrophically, well, you don't have to make, maybe you do. Maybe you learn to find ways to make money during that. I know personally my strategies are set up so we can actually do that. But again, maybe you only lose a little bit during that period. Now, all of a sudden, you can see your numbers going a bit higher. That's how it happens. But capitalizing on crisis should be part of everybody's investing philosophy going forward. For me personally, the reason our portfolio does well in bad periods and why we've never suffered any drawdowns of any significance is because each one of the strategies also has a method of moving to safety first, and then if things get really bad, actually finding ways to strategically short the market through long volatility and things like that. So capitalizing on crisis will also be something people can focus on. These are ways that you can actually significantly outperform the S&P, even if it's flat. Doesn't mean we can't use it for some success going forward, but we have to understand that there will be crisis. If I'm wrong, then I guess I'm wrong. But boy, I think it's a little bit naive to think that we are somehow just fixed the world by doing this kind of thing. This is what actually fixed the world. For 100 years, we were going through these cycles where bad things happen and we have to suffer through it, and there's major asset repricing. And now all of a sudden we solved the problem. We just turn the machines on. We just print more. It's okay. GDP's not keeping pace. It's fine. We'll just print more money and we'll pay people to stay home. It's fine. It's going to work out just fine. Don't worry. That's what they're trying to tell us by these actions. And remember, don't trust what somebody says. Don't wait for the Federal Reserve Jackson Hole meeting and intently listen to what Jerome Powell is going to say. Don't wait for the Fed minutes and go over it and say, well, I think I'm parsing through this. Don't listen to people's words. Look at their actions. What are the actions showing us? Do we need to wait to listen to Jerome Powell speak to know that the economy is being completely butchered by all of this debt and massively outpacing the GDP? I think we can look at the actions and conclude that while I can definitely give them credit for doing a stellar job of managing crisis over the last 12 years, in the sense that nothing actually collapsed for 5 years straight, I don't know how they managed that, but they did. I don't have any confidence that they're going to be able to do that going forward. So I suppose we can kind of wrap it up there, where this number that we concluded to, this 5.8, and I will do a future live stream on bonds and really dive deep into why I say that mathematically speaking, the bond bull market is also over. If anybody thinks that a 60-40 fund is the way to go these days, bad news for you. But this number, this is what the S&P returned over the last 31 years. I personally believe, and you can think what you like, I personally believe it's going to be at least half that, and we very well could see one of those periods of zero growth, inflation adjusted, for the next 25 years. When I'm 71, the S&P 500, the actual number, wait, am I on a screen share? Yes. The actual number might say something significantly higher than 4498. It might say 6,000. It might say 10,000. I don't care what the nominal number says. Inflation adjusted, it might be zero. I really believe it could legitimately be zero. I believe that bond returns could legitimately be zero. I believe that real estate, when adjusted for inflation, again, your home price value, what the assessment tells you every 5 years, that value is going to go up. Your nominal house value is going to skyrocket in the future. You bought your house for $300,000. Eventually, if you wait long enough, it's going to say it's worth $1.5 million. That's just how inflation works. But adjusted for inflation, I don't believe your home's going to appreciate at all in the next 31 years. I really don't. So we need some out-of-the-box thinking. We need to decouple from the stock market. We need to find new ways of investing that can actually profit with or without the stock market's help. And of course, capitalizing on crisis is definitely going to be an important step going forward. And I would encourage people to consider the volatility trade in that respect. Volatility trading does, or option trading, it does actually provide ways for people to profit when stocks are flat, profit when stocks are going down, decouple from the market, and actually make a decent return. So we've got weekly live streams. I'll try to do my best to choose some interesting topics, and we will unpack all of these individual things, of course, in the future. That little slideshow. These things we can unpack, talk about these further. There's lots to talk about on the inflation front. The productivity is one thing that obviously scares me a lot, in that I'm just seeing society going in the wrong direction with that. There does seem to be a alarming increase in not only financial, but just emotional dependence on the government. Don't think that's going to end well. I know that's a cliche, and everybody says, oh, this is not going to end well. I'm telling you, this is not going to end well. It's a cliche because it might actually be true. I don't like where we're going here. So I can certainly mine data in the past and say, well, the last 12 years has certainly done very well. I think all of us, we need to start today looking forward. What's the best way to trade starting today? Forget what you did in the past. Did you lose money? Did you make money? If you made money, great, that's fantastic. If you lost money, it can be forgiven because you can start today moving forward. But always, 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 because our money isn't growing from what happened in the past. Our money grows starting today. Every dollar I allocate today, regardless of whether I've lost money in the last 5 years or not, I need to make sure that that new dollar is allocated well. And of course, I have my methods. Hopefully you have yours. I just want to get people thinking that the world is nowhere near as safe from an investing perspective, from a retirement perspective, as we are being led to believe. So we will wrap it up there and get to the Q&A. I know I can see there's quite a few questions here. My throat did okay. I feel okay. Like I said, it's not the thing. It's I already had the thing. Plus, I already had my pokes. So it's just run-of-the-mill flu. I tried to go to a Starbucks recently and coughed a few times, and just everybody, all eyeballs in the entire place is on you. And the second you cough, everybody looks at you. It's ridiculous. So I've been working from home a lot because it's been a little bit annoying. All right. let's get to some questions. So if everybody would be so kind, just give the video a quick like for me. It helps the algorithm. It, makes YouTube think that it's really popular and it should drive some traffic. So hit that like button if you don't mind. And I've got my Twitter handle there. You can follow me on Twitter as well, @VolatilityVix. Let's get into these questions. So it says, in one of your videos, why roll yield is so important, you demonstrated that going short vol while adjusted roll yield was greater than X amount improved short vol results. Yes. So if the roll yield, essentially the combined number, the VX30 of the front 2-month VIX futures, is significantly above the VIX index, that can be a decent time to be short volatility, and it can improve results. Yes. Could a similar scenario be achieved by going long on SPY or QQQ when roll yield is greater than X%? Yes. I see one more here, so I'm going to finish it and then answer that. Any tips on getting a data source? Okay, let's go back. I'll get to that, but let's do this one. Yes, of course, absolutely. The short vol trade, technically speaking, when you buy the S&P 500, you're shorting volatility. That is a short vol trade. It's just a different structure of a short vol trade. You want stocks to go up by being a low volatility environment. That's what short vol means. So whether you're buying real estate, like when you buy a house, it's a short vol trade. It's a quasi short vol trade. Why not? It benefits from stable markets and slow incremental improvements, right? So yeah, absolutely. You can apply all of the metrics from volatility into stock trading. Now, the only difference being, it's not a one-to-one correlation, of course, because the stock market, if it stays flat, it's flat, right? So if, say, for the roll yield remains completely consistent because the market did nothing. So for a whole month, the market does nothing. The VX30 to VIX roll yield remains completely the same number. The short vol trade itself, don't ever recommend shorting the ETFs directly, but for the purposes of speaking here, shorting the VXX or shorting the UVXY. Again, don't do that. There's better ways, more efficient ways. But that could actually still make money, even if the stock market treads water. That's really the only difference. And likewise, the short vol trade can lose money even when the stock market is staying completely flat. So it's not a one-to-one relationship. But yes, absolutely, there is definitely some significant crossover with these two signals. And anything that is a sort of green light to short vol could also be used as a green light to go long the stock market. So yes, roll yield is very important to understand. Even if you're never planning on trading volatility, you're never planning on option trading, all of the volatility stuff we talk about is still important for you as a stock trader, as a bond trader, precious metals. It all applies. Everything positively correlated to the stock market is technically a quasi-short vol trade. It's just different leverage factors. It moves through time slightly differently, but I happen to like the short vol trade more because it's more quantifiable. But yeah, absolutely. So what's the next part? Any tips on getting a data source other than VIX Central that calculates historical roll yield and SPY close price? I'm working on something behind the scenes that might actually help you with the historical roll yield. Can't guarantee anything, but give me a few months to work on that. I don't know any data sources that will do it for free. So I would imagine what you need in order to calculate the roll yield yourself, you can do it in a spreadsheet, but you do need the underlying data. You need the VIX futures, you need the expiration cycles, you need how many days to expiration. From there, you can calculate how much daily roll there is. Typically on an average, let's just say 5% a day, the VXX will be rolling from 1 month to the next. The VIX futures will go maybe 5%, some months 4, some months 6, but from M1 to M2 every single day. You can do all of this with just the VIX futures and just the days to expiration. Getting that data might cost you money. VIX Central can do it, but it would just be extremely tedious because you can use their historical button. But going back to March 26, 2004, that might take you a while. So you might have to pay for that data. But you can calculate all these things yourself. And on my website, of course, just for everybody interested, not to keep referring to the website, I don't typically do this, but if you go to dashboard, in a lot of these metrics that I'm talking about, I actually show how you can calculate them, right? So I don't know, for example, the trader's VRP. I actually went through, if you want to know what it is, just by using the formulas that I'm telling everybody, you can actually go ahead and calculate this, right? You can do it yourself. This is what all of this is for. Not only the education on what it means and all the data and, you know, stuff like that, but also just knowing how to calculate it. Now, again, you will need the underlying data, so find a source to get that, and then you're good to go. Just start a spreadsheet and start working. Okay. In my opinion, you can be more aggressive on stocks when roll yield is high and should stay away when the VIX is above its upper 20-period Bollinger Band. So this is in response to the previous question. Yeah, you can be more aggressive on stocks. Now, I'm not saying leveraged, but yeah, I agree with this. You can be more aggressive if the roll yield is high. If the M1, M2 VIX futures are significantly above the VIX, I see no problem with holding the S&P 500 during that period. So that's true. I don't know about this Bollinger Band aspect. The problem with that is you're dealing with VIX futures that expire every single month. So trying to do technical analysis on something that literally is a different underlying asset every single month and technically every day, just a constant rolling, decaying product, you can't really chart the two things. So what's a Bollinger Band of the VX30? Well, that would be completely irrelevant. I mean, your software will chart it for you, but it's not going to be relevant to anything you do because you look at a Bollinger Band 6 months separated, well, the futures are just completely different VIX futures than they were before. So I don't see how technical analysis would have any impact at all on what we do in volatility trading. That's why everybody on Twitter, every time somebody tries to draw lines on a VIX chart or a VXX chart, you're going to get volatility experts who come in and say, well, what are you doing? Like you're charting something that can't be charted. Your software will draw the lines. It will give you the Bollinger Bands. It will tell you the RSI. It'll tell you the MACD. It'll chart it and it'll look like it's on there. But it will be completely irrelevant information because in the case of VIX futures, they expire every month. And in the case of the VIX, you can't own the VIX. There is no underlying. It is just a statistical representation of S&P 500 options activity. You can't chart something that is a derivative of a derivative of a derivative all the way down like 6 different levels. It doesn't translate. So I would skip that second part. That was a long tangent rant of saying, I don't like that Bollinger Band reference. Voltrend to give back more off topic. Sorry, I missed one. If you incorporate anything that would be similar to pairs trading metrics for vol versus equity due to the distribution of returns between the two. Sometimes in VTS Options, the service is put on hold temporarily, but we had a pairs trading strategy in there. And sometimes I do like to pit two things against each other. You can actually do that. One of them that I did actually a full video on the YouTube channel, might be interested in it, is, let me see if I can actually give you the title of that video. Let's see. I know it's 3 times SPY, something like that. This one, VXX versus UPRO. This offers a fairly decent pairs trading opportunity in that the actual long-term beta of the VXX and triple leveraged stocks is fairly similar. But how they get there is very different, of course, because like I said, when during different times of contango and consistency and backwardation and certain things, sometimes there's a disconnect between what the stock market's doing and what volatility is doing. So if you did a pairs trade between them, say, don't rush out and do this, do your own testing, but just a super basic example, buying the VXX when the VIX futures are in significant backwardation, and then shorting 3 times stocks at the same time. Or, sorry, buying the stocks. Doing this live on camera is difficult. But anyway, long one, short the other, and then during contango, flip it over. Of course, you'd have to find the flip point there. But when stocks are strongly in contango, the short VXX trade does better than the UPRO. When it's strongly in backwardation, triple leveraged stocks perform better than short VXX. So there is a pairs trade opportunity there. Sometimes I'll do a long dated straddle versus a short dated straddle. Sometimes I'll do, shorting both the triple leveraged ETFs when they exist. What was the old dust and, the triple leveraged oil and gas. Some of them have been deleveraged, but yep, we do pairs trading as well. If you hate Tesla or if you love Tesla, you can pairs trade that, where let's say you're long Tesla and short the NASDAQ, or maybe you are short Tesla because you hate it, and then you're long the QLD just to cover a little bit of your bases. Maybe you think in the next crisis, maybe the QLD will crash 50%, but Tesla might crash 80%. You do a pairs trade between the two of them, and you arbitrage the middle ground. So yeah, absolutely. We do lots of stuff like that. I'll get VTS options going in the future. Don't worry. Pairs trading is fun. There's lots of opportunities. And like you said, the highlighted one, there is a difference between how vol moves around. More comprehensive. I should get to other questions, but let's see this one. A more comprehensive pairs trading seems like the best way to measure this, but it must be replicated through similar metrics, VXX minus SPY beta. I do track VXX minus SPY beta. It's an important thing to know because our vol trend strategy is kind of based on staying ahead of vol decay by shorting VXX puts, knowing that if that trade goes poorly, certainly everything that I'm long the market is going to do really well. So I just want to know the long-term gap between those two. During times when the VXX is decaying way faster than the S&P is going up, could be a problem for vol trend. 2021. During times when the VXX is not decaying nearly as fast as stocks are going up, which does happen a lot as well, vol trend would crush it in that case, and the portfolio can do well as well. It just happens to be a year where the VXX is outpacing the SPY, and then we see a 15% spike, and then the VXX outpaces SPY, and then we see a big spike. It's a pretty poor environment for that vol trend strategy, to be honest. Okay, lots of hellos. Hello, everybody. It's been almost an hour. Thanks, everybody, for showing up. Okay, a lot of hellos. Do I have this set on? I think I'm viewing just the regular chat rather than the questions. Here's one. VTS specific, but here's a question. I'm trying to understand how VTS would do during prolonged bear markets, 2000, 2008, 2009. On the website, Tactical Balanced is the only one that goes back before 2008, but it's very hard to read the P&L at the beginning of the chart. Have you simulated those periods? So the problem with this is, I launched VTS in January of 2012. So we are coming up on our 10-year anniversary now. And let me use the unleveraged strategy. So this is all live trading, and we're coming up on 10 years. Now, the reason that you only see this chart and you don't see anything before this is because, well, A, this is live. This is what every trade that I sent out to a real paying person would have made, right? This is just includes trade fees and all that stuff. I can't go back further than this for two reasons. One, it wasn't live before then, and I think it would be a little disingenuous to show what I think would have happened. But two, even though all of my strategies are quant-based, totally systematic, I can backtest them as far back as I want. The problem is volatility metrics themselves don't go back very far. The VIX futures launched in 2004. The cash VIX term structure, some of the cash VIX, like the VIX 9D, VIX 3M, 6M, we don't have data that goes back before 2007. A lot of the other metrics, we don't have data that goes back that far. VVIX, for example, not that I use it very much, but we just don't have that. So unfortunately, I can't drag performance back very far. The reason you mentioned Tactical Balanced, where I can actually drag it back pretty far, can see where's the live. So right here, we launched live, January 2012. You can see, obviously I am, right here for my mouse, I am showing something going back, but it can only go to here. And the only reason is because this specific strategy is using metrics that had data going back further than that. Whereas the one that it affects it the most is the defensive rotation strategy. I can't drag it back any further than this. This is as far back because the metrics that this strategy is using don't go back that far. They go back to 2007, and I need 5 years of data in order to have those signals be robust enough to use in trading. So 2012 is the best I got. I can guess, and it's more than a guess. It would be an educated guess. I can tell you that the strategies are designed to profit during bad periods. I mean, all you have to do to know that is just to look at our general performance. Pick out a period where the market was doing really bad. Our performance was not doing bad. Like I said, we are disconnected from the stocks. And Tactical Balanced actually did on the backtest. Remember, live trading 2012. This is a backtest, but it did exit to safety and didn't lose any money during the financial crisis. I would imagine that's the same. For tactical volatility, aggressive vol, these strategies go into long volatility. So if we do get lucky, and I want to dance around this a little bit because recessions are awful for most people. And I don't want to say that I'm looking forward to a recession because I'm not. A lot of people get hurt during recessions. So I want to be very careful how I word this. But specifically to my performance, if we did get a financial crisis again, I would expect to make a pretty significant profit. I would do it with a frown on my face, knowing that the world is crumbling and it's a crisis that might take 5 years to work itself through. But as far as my actual trading account, it would probably do extremely well because of the way that my strategies work. They have the lower band of, say, 60 to 70%, where we are more correlated to the stock market. Then we quite quickly move to safety for another band. And then that high 10 to 15% can actually be used to go not short the market. We don't ever actually short stocks, but long vol, cash, precious metals, increasing our positions to all of those things and actually make money. So apologies that you can't actually see much further back. It's not because I don't want to show it. I do. The strategies would show very good results during the financial crisis. And if I could go to 2000, show great results back then as well. But I can't. The metrics don't exist, and I'll just have to prove it. You know, the next time we get a crisis that lasts longer than 3 months, I think people will see that, oh, okay, so VTS is sort of we've done very well during the bull market, but I always say that VTS is sort of a tail risk fund as well. Like, we do plan to make money during the bear market. Not going to be happy about it. Recessions are awful, but I'm going to definitely make money during it, if that answers your question. Okay. Please explain how to calculate the adjusted M1, M2 VIX futures using adjusted contango, adjusted M2 minus M1 over adjusted M1. Correct. I'm not getting your figure. Maybe I'm using the wrong number for future roll. Could be. I don't have a spreadsheet open because I had actually a pretty catastrophic failure of all my spreadsheets. So I didn't even open one in this live stream. Let me see if I can help you out with the VIX Central. So, of course, you can get the formulas on my website, and you already had the formula there. So you're saying it came out to a different number. So, for example, M1 value right now has 20 days left on it. Let's just assume for easy math that this cycle is a 5% daily roll yield month. So every day, 5% of the M1 is moved towards the M2, just for easy math. So all you would really do is do the number of days times that 5%, multiplied by this front month future value. So you would do 19.35 times 20 times 5%. That's that number. And then the second, that's M1. That's the adjusted M1. The adjusted M2 is everything the same, but 100% minus that number. Because, of course, there's far less days right now in this one. So we want to do 100% minus the 5% and then deduct a number of days there. And that's the adjusted M1, M2, or the adjusted M2. So I think I actually went through that in this. I don't know for sure. This is written ages ago. Did I actually show it? Yes, I think I did. I did. So the formulas are there. This might be more appropriate to email me because apparently you've just got the simple calculation wrong. So I assure you that's correct. That's the correct way to do it. The M1 times basically the days to expiration times the daily roll yield, and then the M2 times the days to expiration minus the roll yield, but 100% minus that because you're going from the opposite end. You don't want to count it twice, right? If you don't use that 100% minus, then your M2 adjusted is going to be way too high a number. So email me that one. I can probably fix it up pretty quickly. This was, do you offer VTS options? Not currently, no. I've talked about this a lot at length, so maybe this is your first stream. We did have a VTS Options service. We did have a lot of people on it. I think there was like 600 people on it. But I wanted to sort of shut it down for a few months and build out a video library for all the individual strategies and then kind of relaunch it again. There was a lot of follow-up questions. Why am I doing this? What does that mean? The daily emails were great, but the actual overarching explanations weren't as good as I wanted. So I want to build out a decent database before I relaunch it. So it's coming. Stay tuned. I don't like these questions. Nothing against you. I just don't like these questions. What do you think about a portfolio running UPRO minus TMF 60/40? Essentially, your stocks and inverse bonds. I just don't like these because what you're essentially you're just doing the same version of the same error that a lot of the asset managers, I would dare say most asset managers in the world right now are making. The mistake they're making is that the next 20 years is going to look the same as the previous 20 years. I went through pretty lengthy explanation for why I believe we are in completely uncharted territory here. And what we see going forward is not going to look anything like what we saw in the past. So you can switch the numbers around and you can say, well, okay, instead of doing 60/40 long in both, I'm going to short the bonds and I'm going to do triple leverage stocks here. But you're still using the same erroneous data set, basically, that's not going to repeat itself. So I totally agree with you that you could probably structure this in a way that sort of flips it on itself and says, well, now it's going to reverse. But what is that based on? It's not based on anything. So what I always recommend is start today going forward and make the best decision you can today. Historical data is important, but try to use as little of it as you can with actual portfolio construction. Don't assume that just because something did something over the last 20, like your TMF holding or your UPRO holding, that you can suddenly just change the allocations, or instead of 60/40, I'll make it 80/20. That's all based on something that's going to be different anyway. So let's just think completely out of the box. Let's try not to try to salvage the 60/40 stocks bonds fund, which I think is unsalvageable. And unfortunately, the vast majority of the world is in some form of that. Like 90% of investors, you might think, okay, I've also got real estate. I've also got precious metals. I've got, private equity and hedge funds. But the correlations during a crisis, they all rise significantly and basically track the stock market anyway. So most people, even though it doesn't look like a 60/40 fund, most people are in a 60/40 fund. They just don't know it. Most people think they're diversified. And then a crisis happens and they realize, wow, I lost everything the stock market just lost. I thought my real estate was supposed to protect me. I thought emerging markets weren't supposed to go down. I thought all these things. Most people are in a 60/40 fund. Let's not try to save that. Let's just abandon it and move towards something better. That's my recommendation. Yes. Past performance is not indicative of future results. That is true in all aspects of investing, including why I think people should finally abandon the idea of tracking a quasi 60/40 fund. I just don't see how that's going to work out for anybody. Including, I should keep going with this just to make it abundantly clear what I mean, including shorting them. If you're including somehow, okay, well, if that's going to be terrible, then maybe I just inverse it. Well, like I said, it could be zero for 30 years. The inverse of zero is still zero. So we need to do better than that. We definitely do. Is there a story why vol metrics work? Changes in volatility market lead the equity markets. Do systematic strategies need a story? Well, the story is like I've mentioned several times. The reason I love volatility metrics and the reason why I can use them so successfully to manage my drawdowns. If you look at my portfolio drawdowns over the last 10 years that we've been, live trading, there really isn't any difference. Like the largest drawdown was 7.7. It was right there. Actually, you know what I should do? Just really quickly, let me open up something else here. Let me open up today's email because I know in the emails I actually have a pretty good chart that will show this better. So what I'm getting at is come on, internet. Why didn't it load the second half of that email? I'm trying to speed through it. All right, let me give it the proper time and ease into this. So this is to... What is going on? Am I still live? Is everybody still here? Still looks live to me. Why is that not showing? Okay, here we go. Sorry about that. Watching me fumble around with this. Should have had it open. That's the leverage portfolio. Our drawdowns for our portfolio, minus 7.7, 5, 3.8, 5, 5, 2.64. You can see there's really no difference over time with my drawdowns. Well, how can that be? Like, obviously in 2012, this drawdown, in May of 2012, the stock market actually drew down about 9%, I believe. But that was just a very problematic period for Volmetrics itself. The XIV, the old XIV, crashed about 40% when the SPY didn't do much of anything. And then 2015, the stock market crashed. In 2018, we had Volpocalypse in Q4. COVID, it went down 35%. All wildly different stock market crashes, totally disconnected from each other. The structure of the crash during Volpocalypse in 2018 was entirely different than the pandemic crash or the China hard landing crash in 2015. Wildly different, including the absolute levels, the relative differences, the time that the drawdown lasted. Totally different. Volatility metrics were basically the same, especially if you rank them in relative strength over time. They were all basically the same. So from my perspective as a trader, I don't really care if the pandemic causes a 35% drawdown or if the China hard landing scare causes a 15 or what was it, 18.79, I believe. Don't quote me on that. Or whether something else that was only 10 or something else that in the future that's going to be 55, like the financial crisis at 56. I don't care. The vol metrics are going to be the same through all of that. My volatility barometer is going to touch the same level within 1 or 2% probably during all of those crises. It's going to touch the 85 to 90% range no matter what the stock market does, no matter how bad it gets, the drawdown, the magnitude. My vol metrics will react the same way, which means my portfolio should react more or less the same way, which means my drawdowns should not have any that stick out like a sore thumb, right? Unless something really breaks down in the market, it really should be a fairly consistent expectation that the vol metrics in 2028 are probably going to look fairly similar to the vol metrics in the financial crisis in 2008. Those relative levels and the momentum changes between them should look about the same. The same cannot at all be said about the stock market. So if you need a story for why volatility metrics work, that's the story. They work because while the absolute levels are wildly different, right? Of course, in the pandemic, the VIX went to 82.69. In other crises, it only went to 48. In other ones, it might go like in the October 87 crash, the old VXO went to 172. Wildly different absolute levels, but relative strength, that's the 99.99 percentile, no matter what market you look at across all of time, that's going to be the 99th percentile. That's all I care about. Is it bad? Yeah. Do I care that this one is way worse than the other? No. Do I care that the financial crisis was technically way worse than the European debt crisis? Not at all. They're all 99th percentile values, all of them. So who cares? I don't care at all. So that's the story behind vol metrics, why they work. What's this? How long have we been going? It's getting close. Actually, my voice is doing well. Recession cycles get longer over time as government and central banks get more skilled at regulation and response. I'd push back a little bit. I understand your general point that, clearly we've gone 12 years and is there anybody out there that doesn't think that's because of financial engineering, that we just got lucky somehow? No, we went 12 years instead of 6 because of financial engineering. That's what happened. Let's just accept it. So yeah, I agree that in this current cycle, they were able to push it back 12 years. That's why I said, while I disagree 100% with everything the Fed has pretty much ever done in the last 10 years, and the government as well, points for doing something that I didn't think was possible, pushing the markets to all-time highs for 12 straight years, basically. Didn't think that was possible. But I don't think we should get used to this. I really think that at some point we're going to go back to the old style where massive asset repricing is part of the normal cycle. There's nothing wrong with the financial crisis. The only thing wrong with the financial crisis was what they did to lead up to it that caused it in the first place. That's wrong. And how they responded to it after is wrong. But the crisis itself, a massive repricing of assets, this has to happen because we're human. We don't go through equal periods of fear and euphoria. It's never 50-50. It's 80-20. It's 90-10. Most of our days are good days. That's why bad days feel so bad. Most days the sun is shining. That's why rain sucks when it rains. If it rained every second day, we would have already built technical umbrellas that are just attached to our bodies, but as humans, we are confident and positive and in general stable status quo most of the time, which means that it's going to outpace for a while and then hit, and then outpace for a while and then hit. We need that hit in order to go to a further outpacing. If you stop the hits and you stop the assets from repricing, what ends up happening is you'll get 20 years of repricing instead of 4. That's what happened after 1929. It takes until 1956 to break even. That's what happens in 2000 when things get so obscene that it's going to take 15 years to work through that. That's what we see. So what the Fed has done, what the government has done, while you can sort of say, hey, that's interesting that you were so successful, it's cliche, but it's just prolonging the inevitable. And the future repricing is going to be significantly worse than it would have been if we just stuck to the old 6-year recession cycle. Just let it happen. I'm not saying like hurt people. Counter-cyclical fiscal policy is a good idea. So when we go into a recession, that's when you start spending the money. That's when you start giving people social safety nets. Not when the markets are at all-time highs and unemployment is at the lowest it's been in, 10 years. It seems like, I have an economics degree, which is all but worthless. So, joke's on me. But I did study economics. And back then, in the 90s, we actually thought counter-cyclical fiscal policy was not only a good thing, but it was somewhat similar to what we were seeing, more or less. Like sometimes you run a surplus, sometimes you run a deficit, and you try your best to run the surplus when you have a lot of money, and you try to spend a little money during the deficit, and it makes sense, right? We're in a period now, and individuals are doing the exact same thing, getting back to the whole minimalism thing. Where's my presentation here? Consider minimalism. You've got a period right now where the stock market is at all-time highs. Most people's house is at all-time highs. Most people, according to the employment statistics anyway, are doing fairly well with their jobs. Consumerism, materialism, and spending is at an all-time high. Isn't now when you'd want to actually save a little money so that maybe if things aren't as good in the future, maybe don't buy the Ferrari when markets are at all-time highs. Maybe save that money and put it away for a rainy day. I mean, individuals and governments are making the same mistake. So a lot of individuals out there driving that Ferrari will be pointing their finger at the government saying, you guys are mismanaging your capital. Meanwhile, that guy's in a Ferrari because the last 10 years, his stock market portfolio is up 300%. That's why he's in the Ferrari. Didn't you do the exact same thing? So my lifestyle does not have any inflation. I live the exact same way now that in good times, my income's the highest it's ever been. The stock market's the highest. Everybody should be fairly stable financially. If you're not now, there's probably an issue. I'm not spending more money now than I ever did. Why would I? Counter-cyclical fiscal policy. I'm actually saving more now. I work harder now. I spend less money now than I did before. I'd push back on that. I would say, if you're an individual who is not saving a massive chunk of your money, you might be committing the same fatal error that the government is committing. And if we go through a 25-year period where the stock market, the bond market, they're no longer cooperating with you, might look back at that $38,000 Rolex Daytona watch you bought and say, should I really have bought that? I mean, I wouldn't buy it in a recession, so why did I buy it at a peak? Government is spending money like drunk sailors when the market's at all-time highs. What is going on? Like, doesn't anybody understand counter-cyclical fiscal policy on an individual level as well? Don't those people on Instagram know that you shouldn't be flossing right now? You shouldn't be flexing. You should be saving. They don't know that. They might be reminded of that if we hit a recession. They might be reminded of the fact that actually you were supposed to just be enjoying life, enjoying the simple things in life, the relationships that we have with each other, the experiences in life, and forget the things, forget the stuff. Stuff is irrelevant. So same with government. It's stuff. They're always buying stuff. Forget the stuff. Give people experiences. Give people freedom. Give people an actual standard of living. Give people security. Give people, health care. Give people the things that matter, not stuff, not inflated asset prices and all that, Wow, that was a rant. Keep going. Please hold your questions. Oh, interesting. I got a moderator. Thank you. That's cool. Hold your questions. Yeah. Thanks. It's very cool. All right. I'll do a couple more, but we should probably wrap this up. I'm starting to rant a little bit more. I don't want to get preachy. I'm not that person, but hopefully my experiences can help a few people out there. Oh, I see we lost a yellow light in the background. The way we invest a substantial amount of our portfolios consist of cash at least at certain times. With negative interest rates now, what do you recommend doing when in cash positions? So far, kind of the same. So not a whole lot of differences now for me personally. If we look at our strategies, not a whole lot different. So we still hold IEF bonds as our safety position with tactical balanced, and then we will still move into full gold during all-out crisis. Like if stock market, this is a pretty high level. It's not going to flag very often, maybe 10% of the time. I'm comfortable holding gold when equities are just getting destroyed. I'm fine with that. This strategy is healthy cash and then long vol. We can actually go long vol and capitalize on those extended drawdowns. Here again, we have a bond position. Now this one is starting to get a little controversial because while it is mathematically true that these TLT positions for our strategy have still been beneficial, and same with the IEF, it's not as beneficial as before. Bonds may not be the best protection like they used to be. So going forward, of course, it's my job as as a risk manager to always make sure that starting today going forward, I'm in the best positions. If I have to move this to something else, which spoiler alert, I almost certainly will. I'm currently redesigning this strategy as we speak, and there's a very good chance this TLT will disappear. It won't be TLT anymore. And this one is utilities, right? XLU and then just cash on the high end. So I think, yes, you're right. We do have a lot of cash. We do have some bonds, but we do also have a healthy amount of long vol. We've got some utilities. I'd like to add some things like, maybe basic materials or some type of consumer staples ETF that while it will go down, it might be protected a little more. There are ways to do that, but interest rates are a problem. Obviously, like I said, the inverse correlation between interest rates and bond prices. Now would be a good time to consider ways that we can reduce our reliance on both of those, stocks and bonds, and reduce correlations. The difference being I'm only ever holding bonds when the market is going down, during safety positions, when volatility is so elevated that I'm holding bonds. During those periods, bonds is still good. Buy and hold, I would never have held bonds. I wouldn't even have held them in the last 20 years. That's not my style. But these days, it's a pure tactical position, and it's still technically profitable. Our IEF positions are still making money when we move into them. It's not often, but when we do, for the most part, they have still been making money. This is funny. I spend literally 100% of my waking hours trying to beat the stock market. Yeah, that's good. That's your video game from this day forward. No more games, no more TV, no more. We're going to build careers that we love so much that we'd rather trade. We'd rather crunch numbers in a spreadsheet rather than play video games. You know, that's going to be the future for people who succeed, are those who build a strong foundation of a good career. So I'm glad to hear it. You might have to eat a few meals. You might have to hang out with your spouse a few times. So I don't know about the 100%, but that's a funny comment. If our portfolio is closely correlated to the stock market, then going forward, returns may likely not be great. Yeah, I would say that in my mind, it's a near certainty they'll be terrible. Anytime you're correlated to the stock market highly, over about 80 or 90%, I can't imagine success follows for the next 20 years. I just can't see that playing out in any way, shape, or form. I think we're going to go through periods of just euphoria where everybody thinks, oh, thank God the market's not crashed. Thank God the Fed's there to save us. And then we're just going to go through periods where it just fails wildly and spectacularly. And everybody's like, well, I thought the Fed was supposed to save us. I would not want to be correlated to the stock market right now. I would never have wanted. I've handily outperformed it by being super low correlated. So the idea that you have to trade stocks to beat stocks is just totally silly. I mean, we hold stocks, but it's actually like I said, whenever we're holding the SPY, you could just substitute SPY for short vol. That's what it means. We are short vol. The methodology, the vehicle that we're using to short vol is stocks, the NASDAQ, short vol, VXX, UVXY, options, things like that. Broken wing butterflies skewed to the upside, iron condors that have, that positive theta. Short vol. Just anytime you see something like that, I'm either short vol, cash, or long vol. That is my entire portfolio. What we use to accomplish it, don't let that deceive you. I'm not actually a stock market trader. I'm just a short vol, cash, or long vol trader. Okay, we should wrap this up and do another live stream. I like to do these every week, so I want to save some of these questions. There's tons of them. Thank you so much, everybody, for showing up and listening. And I think there was only 1 or 2 rants today, so not too bad. Give the video a like on your way out the door. And good luck in your investing. Think about what I said. Reduce those correlations. Stocks and bonds may significantly disappoint you going forward, so keep that in mind.